Markets and noon, a quick look at the markets. So for now, Nifty 50 is still holding above that 24,750 mark, but it's Nifty Bank taking a bit of a hit, is now drifted in the red territory as we speak right now. And well, of course, the heavyweights like Kotak, Axis, IndusInd Bank are indeed putting pressure. Add to that list is SBI, which is now holding on to the cuts of 0.4%. So that's the construct of the market. But what's the way forward from here on, and which are the themes that you should be betting on? Let's try to decode that with Deepak Shenoy, who is joining us on the show right now. He's the founder of Capital Mind. Hi, Deepak. Great to be speaking with you. And firstly, Deepak, what's your current view on the markets? Because though we are witnessing the global uncertainties, and that's been a cause for the day, and day in and day out we get to hear from President Trump as well. But back home, Deepak, the earnings season hasn't been that disappointing so far. So help us understand, what do you make out of it?
Yeah, so Shruti, I think the big thing, the problem right now has been the uncertainty from tariffs, from geopolitical situations, both India, Pakistan, and perhaps complexities in the Israel, the Middle East, and in Ukraine and Russia as well. On top of that, you've got other uncertainties which are slowly evening out in terms of whatever our earnings situation is. Now, if you look at overall Nifty 500 earnings so far, the median earnings are have grown about 14%, which is actually not bad at all. 350 companies odd have put out their results. So we don't seem to see a stagnation in earnings growth. 14% is quite decent for the Nifty 500 as a median number. And I also believe that a lot of revenue growth, at least for the domestic story, is up ahead of us from a perspective of increased consumption because perhaps of the tax cuts which are applicable from April onwards, and also because of lower interest rates which are applicable again from April. So it'll take us about 3 or 4 months for the rates to trickle down to corporate borrowing rates, to domestic retail borrowing rates as well. But I think that will also drive up more consumption, more revenues, therefore, for companies going forward, and perhaps some more capex as well. So I think India as a country remains quite strong from that perspective. There are some worldwide headwinds in terms of world interest rates going up, in terms of yields. So you're seeing American 30-year yields flirting with 5%, Japanese 40-year yields at 3%. Even yields in Germany and in UK going up. So I think that has an overall broad macroish concern. But I mean, I think India is in a much better situation than most of the rest of the world, and perhaps what India was also maybe 6 to 8 months ago.
All right. Hi, Deepak. This is Kanishka also joining in. A very good afternoon to you, first of all. Now, while you did speak about how India is resilient and, you spoke about the consumption space as well, I want to understand, are you, we're 5 months into 2025, are you seeing any signs of sector rotation? Which pockets are losing steam, and where is leadership emerging from?
So I think clearly, Kanishka, we've had a sector fall in terms of both, I think, to a certain extent, pharma, but very largely IT. So IT has not recovered meaningfully. Banks, on the other hand, have recovered quite meaningfully since the Feb and the April rate cuts. We've had some NBFCs start to come back as well. Not all of them, but some. We've also seen FI resurgence in May, which is the first time we're actually seeing any kind of inward flows. So I think net about 10-15,000 crores in May, but it's actually quite the reversal from the first few months of the year. There's also been I think overall the sector rotation. We've started to see a lot of the mid and small caps recover quite sharply from the Feb lows. We're seeing this overall as market cap based, but we're seeing some of the domestic manufacturing and industrial plays start to demonstrate much better, both in terms of earnings, in terms of stock price movements, better performance, and also better economic outlays for the future. So there has been, there will always be, every few months there will be something new that kind of comes and takes the charts. But domestic consumption in terms of the large FMCG names I don't think there's a meaningful recovery over there yet. And I think because of their pricing and their valuations being very high compared to their growth, they continue to be a little bit more suspect in terms of, taking the bet on them going forward. But I think industrials, manufacturing, defense, these continue to remain good, interesting themes for us to look at going forward. You're going to not be very happy for the next 6 months, I think, because there's still a lot of uncertainty, tariffs, there's deals that are coming up. There's perhaps the end of these wars that are happening. And when we see the end of the wars, when we see the tariff thing kind of uncertainty go away, that's when I think the markets will kind of be more happy.
All right, so Deepak, you're saying that we are in to witness some more of a volatility in the next 6 months. But Deepak, given the fact that some of these companies, and if I can name one is Dixon Technologies, when we talk about that company, what a multi-bagger it has been. We are all aware about the growth and the kind of business that the company is doing, and not just that, even delivering. But the valuations are a bit of a concern, Deepak. Do you believe now is the time wherein such high PE companies can also take a bit of a backseat because they have been richly valued and very well appreciated by the market participants as well? What's your take, Deepak?
No, I think every company will go through a phase of very high momentum and then perhaps high expectations. Sometimes it's up to the company to meet those expectations. Now, Dixon's, as a company, I won't comment on any individual stock, but every of these companies have perhaps looked at high valuations in the past as well. Some of them have actually outperformed those numbers, and in terms of growing fast enough so that you can justify those Ps. In other cases, the stock prices have corrected to reflect lower levels of growth as well. So I think to a certain extent, we should look at some of these things from a perspective of can they do that kind of earnings growth that they're expecting. And overall, I think the last 3 months have been kind to the pack because because of the tariffs, because of all of this stuff, it becomes more evident that we have to make more of this stuff in India for India. So that kind of reinforces the message going forward. So there is perhaps more happening than what is just currently visible to us. So at some point, that may provide an upward surprise. But short of that, you're going to always have to be careful when you buy high PE companies that any negative news can hurt them a lot more disproportionately than a company that has reasonable PE.
Right. Deepak, I want to go back to your sectoral views. Then you did mention that manufacturing, industrials, defense continue to remain your preferred bets. I want to specifically talk about the defense space. The space has been in focus since the Pahalgam attack. Stocks have seen a fair bit of rally as well. And the earnings also fairly good for most of the companies, with especially healthy order books for most of them. So within this defense space, what are your preferred picks? Could you give us some names?
I can't give you names. We've got a mutual fund license, so we don't do names meaningfully anymore. But I think the overall sector looks good for the longer term, mostly because the focus of even the Indian government is shifting to procure locally from domestic manufacturers. So we have zero foreign dependence during times of conflict. You do not want to be buying from a country that does not suddenly decides not to support you in a war. So therefore, the Indian Army, the Indian services, the defense ministry also will very surely move towards as close to 100% domestic as possible. So our domestic players will see serious revenue increases. But this has been happening the last 3 years. So I'm not saying that this is suddenly because of what has happened in the last 1 month. But I think there's more space to go. There will be a lot more opportunity in defense. And we will both do replenishment of whatever has been spent and whatever has been used in the last few weeks or months, but also do new initiatives because increasingly we are getting to know capabilities of people who are hostile, countries that are hostile to us. And to counter those capabilities, we're going to have to build new capabilities. And therefore, there will be a lot more new work that will go into these defense companies. And as I said, most of this work will go locally. So whether it is an electronics company or whether it is a missile company or whether it is a company that does tanks, physical armored cars or trucks, these are all things that I think you'll see more procurement for lately. In the near future, and I think we've bet on a bunch of them. But I think the idea here is that you got to have a 10-year view into these companies in order to understand, I mean, how much space there is. Some of them are expensive, so you have to be very careful on what you buy.
Be a little careful on what you buy. But Deepak, give us some sense that from where do you believe that the next big signal for the markets will come through? Because of late we have been just tracking what President Trump has been saying. Along with that, the earnings season was in full swing, but now a lot's really been happening in the bond market as well. From the global markets across, we are getting to hear some comments on how some of these long-term bonds and the demand, how are they shaping up? What's your sense that from 6 months, when you believe that the markets will be a little bit more volatile, which key triggers you will be watching out for?
So, I mean, I think I'm still watching out for say, a good news around the war coming to an end or something of that sort, which would kind of help reduce the uncertainty going forward. Secondly, on the closing down of tariffs, so I think at some point, America is going to have to make a decision on what it's going to do with these tariffs thing and whether it's going to retain them at this 10%, increase them, or change whatever it has to with China as well. Expect that over the next 3 or 4 months that will kind of ease down. That is your trigger. But honestly, markets look for very sharp and very emotional triggers every day. So that is not going to happen. It's like, a lot of very boring stuff comes. Now, for instance, we've reduced interest rates. That was a trigger, but we didn't care when it happened. And now suddenly we're saying banks are doing well. Of course, banks will do well when eventually interest rates start to come down. You're going to, but it's a delayed effect. So they get good impact for the first 6 months. Then slowly their loans also reprice downwards, and that's when they don't make that much. So we'll have to live with lower NIMs but higher growth. And the banks that will grow the most will make a lot of money. However, these triggers have been kind of ignored by the market for the last, for when they happened. So we didn't think that would do so well, but now it's starting to come to the fore. So we will see this. We will see a change in global inflation. India's inflation will continue to flow downwards in the next few months, I think, and world inflation will actually inch upwards and not downwards. So you will see a very different reaction to interest rates worldwide versus what is happening domestically. So I feel the macro situation is more favorable to India. But this uncertainty needs to get over on tariffs. It'll take us another 3 or 4 months while we whatever Trump says and whatever something else says and all that stuff. After that, we'll be in a better shape to kind of take more decisions. Markets tend to look a little bit forward. So you might see the markets will, kind of start predicting this a little bit earlier than everybody else.
All right. Deepak, I also wanted to get your view on the oil and gas space. On the back of some news flow now, with reports suggesting that Israel may be preparing to strike Iranian nuclear facilities, which will lead to supply concerns. How do you think one should play this sector?
Well, technically, Iran is a is a supplier, but it's not one of the biggest suppliers in the world. I think we'll end up with enough. There's enough supply in the world to be able to beat this. But typically, plus this talk of something will happen is usually, I mean, you can't do this to a nuclear country, really, because they will attack back, and they have demonstrated in the past that they can. So I would say a lot of threatening will happen, maybe some action. And again, markets will get excited in the short term, but in the long term, you have to look at it from a perspective of how much supply exists and can it meet demand. There seems to be enough supply to be able to meet demand already. And a lot of these countries are desperately looking for an opportunity to increase their production because they've decreased production trying to control prices in the past. So if there were a loss of one player, then another player will come in to take its place. So I don't see meaningful increase in demand for crude, and I don't see meaningful drop in supply for crude. So I don't think crude prices are going to meaningfully change. There may be some deals. There's some talk about how Venezuela is going to be treated. There's some talk about for discovering more oil in a few other places. All of these things will put will change supply demand constraints. So they may create some short term imbalances. But I don't think this Iran Israel thing is meaningful more than a short term blip.
All right, Deepak, with this, we'll let you go. Thank you so much for taking the time out and helping us with your view on the markets.
Thank you. Thank you.